right. Hello, everybody, and welcome back to the Sharpe Minds podcast. I am your host, Michael Lafata, and today's episode is going to be amazing. We've had an extremely eventful first half of the year so far. There's so much to unpack in terms of White House policy, the stock and the bond market, Fed policy, possible recession risks, the state of the consumer, and those are just a few. Today, we have the fortune to hear the insights from a firm that is both the largest bank in the world and one of the largest asset managers in the world. Meera Pandit, who works alongside our friends at J.P.Morgan, is joining us today. And Meera, I couldn't be happier to have this discussion. So thank you for taking the time to be here.
Thanks for having me. Excited to be here.
Of course. So as I mentioned, there's a lot of topics that we're going to touch on. But before we dive into it, I want to give you a proper introduction, if that's okay with you.
Sure.
All right. So Meera, you joined J.P.Morgan back in 2011. And today you are a global market strategist on the J.P.Morgan Asset Management Global Market Insights Strategy team. You're responsible for delivering timely market and economic insights to institutional and retail clients and conducting research on the global economy and capital markets. You're a contributor to publications such as The Guide to the Markets, which is a great resource for anybody who pays attention to the markets or the economy. And additionally, you are a frequent guest on Bloomberg, Yahoo Finance, CNBC, CNN, and other financial news outlets. So as I mentioned, it's just a pleasure to have you here. And one of the things I'm curious about is what it's like to work for a firm like J.P. Morgan. You guys have access to so many different parts of the economy. You're in so many different segments. You serve so many different types of consumers. So tell us a little bit about what it's like to work there, and what the experience is like for you, and doing research at one of the best firms on the street.
Well, I'm on the road to 15 years here, so hopefully just a few more years to get to that point. And it's been an amazing ride because I've been able to work in a couple of different areas within asset and wealth management, different types of roles. So certainly from a career perspective, there's a lot of different opportunity. I've been in New York, I've been in London. It's been a really incredible experience. And from a resourcing standpoint, just the breadth and depth of capabilities is astounding. From my role as a strategist, for example, we always get asked about the consumer. The consumer is almost 70% of the overall economy. So how do we measure the consumer? You have things like retail sales, you have consumer spending reports. But at JP Morgan, we bank 1 in 2 households in America through Chase. So we can look at aggregate consumer data on an anonymized basis, but you get some interesting trends in terms of who's buying what and how much at a very high level. So all of those types of insights, I think, are a huge differentiator and helpful for me in my job.
Yeah, I would definitely agree. And I'm glad you touched on that, because I think that's, one of the most important things is, you guys are getting insights from basically every swath of consumer that exists. So you're able to put all that together and, develop really good, really good research, basically. Let's start by talking about everybody's favorite topic, and at a high level, and then we can sort of dive into the specifics of it. But how does your team and the firm view the first 100 days of President Trump's presidency?
It's really kept us on our toes, for sure.
Yep.
I think there was a sense that we underestimated, for example, tariff impacts. Now we're seeing a scaling back on some of those, which we think we, overestimated perhaps how much tariffs would end up staying on. So I think that we're constantly trying to think through what's the next step. And from our purview, it's been really important to think about different scenarios in the market. Here are the extremes, and here are a couple of the ideas in between to get a sense and a gauge of where we might go. Now, of course, we can't predict exactly where we go. We don't have a crystal ball. But I think in this environment, like in any environment, what we try to do is see the present with clarity and simplify the complex. So it's not about what's going to happen tomorrow. It's not about S&P price targets or playing a guessing game. It's about just coming up with a framework for how to think about this environment. And from our perspective here, we've thought about what are the main economic and markets related goals that the administration might have. It's cutting taxes, it's cutting spending, raising tariffs, boosting energy production, deregulating, thinking about some of the different antitrust cases, for example, immigration, slowing down on immigration. So we've essentially thought through all the different silos of the policy that's going to impact the economy. And from there on, we try to get underneath the hood and think about some of those details and the various pass-through market impacts or longer term implications. But it's really all about frameworks and thinking about how things might impact the consumer, the job market, the profits of companies as a whole.
Yeah, it's great that you mentioned that. So let's dive into a couple of those. So tariffs is the one that has been front and center for the past couple of months. Um, why do you think that is? Right. I know that it's been a main objective of the administration to get something passed and sort of implement tariffs at some level. But why are we having the conversation around tariffs in regards to financial markets, the consumer? What are the thoughts there?
First, I'd say during the first iteration of this administration, back starting in 2017, you did have the idea of tariffs, but you also had massive tax cuts, huge consumer tax cut, huge business tax cut that really changed how we operated on a globally competitive landscape. And that was a huge boon for the markets. So when you started to have the tariff conversation last time, two differentiators. One, you had a huge tailwind of tax cuts at your back. So all the tit for tat tariff developments were absorbed a bit better at that time because of the big boon to profits and the overall markets from taxes. And you also had just a lower magnitude overall of tariffs. This time around, that's been the opening gambit. Things like tax cuts, things like deregulation have been pushed to later in the year. We're starting to hear that tax cut discussion pick up, but it's really been tariffs front and center. And it's not that people didn't expect tariffs to come to the fore, but it's really the magnitude of those tariffs that came in pretty high. I mean, for example, last year we had an average effective tariff rate on US imports of about 2.3%. After the announcements from April 2nd, it went up to north of 20%. So that's a huge swing in terms of all the different downstream impacts to companies and individuals. The other thing that's been challenging as we wrap our heads around tariffs is there are strategic goals and there's tactical goals, and they're not necessarily compatible. So if we think about some of the strategic goals, it's let's raise revenue for the government. Let's combat perceived unfair practices. Let's lower our overall trade deficit. Let's bring back manufacturing. If we were going to do all of those things, that would argue for putting on a very high level of tariffs and then letting it run. But what we've seen so far is there have been throughout this year negotiations back and forth on tariff rates, on exemptions around certain goods, things ratcheting up and ratcheting back down. And there are discussions going on. Clearly, there are trade deals or trade frameworks being discussed, and those are designed to extract some sort of concessions. Maybe it's on different auto or pharmaceutical tariffs that happen to US goods when we're exporting them. Maybe it's around defense spending or immigration or drug trafficking, for example. So if you're willing to negotiate some of that away, then that's going to take away from some of those strategic goals. So I think the market has constantly been guessing what's more important, the strategic goals or the tactical goals. And that's why it's been so challenging to figure out where exactly the risks lie, because markets are a discounting mechanism. They're trying to scope out all the different risks from different policy. And because of those swings, it's caused a lot of volatility in markets.
Yeah, and I guess the other big thing is just how the whole introduction of tariffs was delivered. Right? It was just like right off the bat, basically right after inauguration. And he was talking about it, throughout the whole campaign, but just basically first day it was full blown, we're going into this, and not really like a period where everybody could get comfortable with. Yeah, just straight into it.
Right. You had some tariffs. Then they actually, a lot of those came off pretty quickly.
Mm-hmm.
Then you had, let's wait 90 days or, let's wait till April 2nd and we'll give you a more consolidated framework.
Mm-hmm.
And then those lasted for a couple of days and then were paused. So the stop and go nature too means we're constantly swinging in terms of what is the base case, because you go into April 2nd and it's like, oh, maybe we'll get some relief on tariffs. They'll slap on one big universal tariff rate of maybe something like 10%, and we'll deal with that and we'll have to digest that. But nonetheless, then we'll sort of move on from tariffs. But instead, it was everybody has a different tariff, and this is just the opening gambit to talk through this. They were much higher than people expected. Then they're kind of coming back down, they're coming back up. So that first week of April, it's, well, maybe we're definitely going into a recession and it's probably going to be kind of severe, to a week later, okay, now that these tariff levels have gone back, maybe we still have a recession, but it's somewhat milder. Then you have the postponement of the Chinese tariffs at a higher level, and they've come down a bit for the interim period of time. And it's like maybe no recession at all. So we've gone from no recession, severe recession, mild recession to probably going to avoid one. And that, of course, is it's challenging to wrap your heads around.
Yeah, yeah, it's ever evolving. That's for sure. Do you guys have a view on, like you mentioned, strategic and tactical as the two, potential, rationales for why we could be doing this? But do you guys have a viewpoint, or lean, one direction or the other as to what the rationale could be? We've heard the administration say, well, it's how we're going to fight the deficit. It's we want to bring a lot of manufacturing back to the U.S. This is, sort of how we're going to get started with that. To help with drugs coming in and out of the country, stuff like that. Do you guys have sort of, a way that you lean, or a direction that you lean in terms of why we might be doing this?
What the administration says is it's both, and we can achieve both. And perhaps there is some truth to that, in that it's, you can put on a baseline level of tariff. So we think perhaps we're headed to a world where we have a baseline level of a 10% universal tariff. Certainly punitive, it will be a drag on the economy and markets, but it's certainly, as we have seen, also not the worst case scenario or the most extreme. So that type of tariff rate, especially coming down from some of the ones that were proposed, allows some room for negotiation, but that baseline can help from the perspective of perhaps raising some revenue. Now, there are other challenges that go along with some of those strategic goals. So one thing I would point out from a deficit standpoint is that, yes, we do have a large trade deficit in goods, but we have more of a trade surplus in services. And over time, we have reoriented ourselves, rightly or wrongly, from a more manufacturing-based economy to a more service-based economy. That has been a concerted change over time. If we also think about markets, there is this narrative of sell America. Well, the reason why there's this narrative of sell America is because people have been buying so much of America. 30% of our treasury market is owned by foreign buyers. About 20% of our equity market is owned by foreign buyers. So if we were also to think on a country by country basis, the deficit that we have in terms of financial assets, we'd certainly have a surplus there relative to other countries. So it's not a black and white picture here in terms of no one else is buying our stuff. Well, they're buying some stuff, but it's more around services and financial assets, which are areas that, again, we've sort of picked our spots in terms of where we want to win. The other challenge when we think about things like reshoring manufacturing, for example, is maybe that's the goal of the administration, but companies have to be on board. And in order to bring your factory back from, let's say, Mexico to the US, you have to consider that, one, actually, the capital investment of building that new factory while you let the other one, run its course, is going to be expensive. We are in a high interest rate environment, so financing is expensive. It's not just the buying of the inputs and the pieces. Getting the labor is expensive. You probably have higher wages here than you do there. And you also want this to last for the long run. What if you're in a position where in a couple of weeks' time, the administration's policy changes? Or maybe it stays consistent throughout the next 4 years, but then somebody else comes in 4 years and reverses that policy. You're going to build a factory for not 4 years, but 10, 15, 20 years. So these are really long-term capital decisions, and therefore it could be tricky to bring back manufacturing when we think about, do we have the right skills? Do we have the right resources? Is it cost effective? And is it going to be a durable solution? That's the way some of these companies are thinking about it. So it's both parties have to be on board.
Yeah, yeah, it's a great point. Personally, I think it's gonna continue. The trend is here to stay. I think. I just think it's going to take a lot longer than many people initially anticipated, and we're going to run into a lot more roadblocks than we may have thought. You mentioned the other things that the administration has discussed. The extension of the Tax Cuts and Jobs Act, spending cuts, deregulation. All these really good things in theory that that they've discussed. And any thought, any other additional thoughts just around what we could see there, right? I know we've we've had the introduction of a new bill recently, which would extend Tax Cuts and Jobs Act, but it seems like the deficit's going to increase when you look at that. So what are, we hear spending cuts and stuff like that. What are the thoughts there, right? Are we going to see a potential reduction in the deficit? Are we going to make any progress there? Is that something that we should be optimistic about or a little cautious? What are the thoughts on that?
What we're hearing wending its way through the House is this reconciliation bill to the overall budget that would do a full extension of the Tax Cuts and Jobs Act. It would add a couple of other provisions in terms of an elderly care sort of tax credit type of supplement. It would raise the SALT cap deduction from 10,000 to 30,000, and it would exempt tips and overtime from taxation. So some of the taxation that we currently have, extending that out, which would be net, not necessarily stimulative to the economy, but then some sweeteners on top, like the exemption of tips and overtime, which then could provide some pretty powerful stimulus in 2026 when it comes to economic growth. Now, in terms of the spending cut side, right now there's some pretty extreme proposals in terms of 800 to 900 billion on things like Medicaid, SNAP benefits, potentially some student loan reform. And those cuts may not be agreed upon once things make its way to the Senate. So there's still some back and forth that needs to happen within Congress. But one of the ways they've gotten around having a huge price tag to this bill is what they're looking to do is have tax cuts that last for about 4 years, but then spending cuts that will last for a full 10 years. Because basically, when you do a reconciliation bill, it's got to last within a 10-year budget window in order to just get that simple majority through Congress. So what's likely going to happen is you have this price tag on it, and yet you're probably going to end up having to further extend those full suite of tax cuts when you get to 2028, let's say. Now, we've seen that right now. We're seeing that extension of the Tax Cuts and Jobs Act. Otherwise, you have this big tax hike essentially baked in. So in reality, what you're probably going to see is those tax cuts that are only baked in for a couple of years are going to be extended out further, which means a much larger deficit implication. So overall, when you think about either cutting spending or raising more revenue from a deficit perspective, the numbers just don't quite add up. We spend about $7 trillion a year. 5 trillion of that is interest payments and entitlement payments. And the interest payment component is about $1 trillion. It's going to be a little bit difficult to scale back massively on some of those entitlement programs. So you're left with $2 trillion from defense and defense non-discretionary. That's why getting to the DOGE target of $1 to $2 trillion over a short period of time is really hard. Over a long period of time, much more reasonable. Now, in terms of raising more revenue, taxes are a big revenue raiser. So if you start to see more cuts there, then that erodes one of our biggest revenue bases. And maybe you see a higher level of tariffs add on to that, ballpark, maybe something like 200 billion a year. But you can see how that's not going to scratch the surface when we have multiple $1 trillion of tax cuts to pay for. So all that being said, our deficit right now is at about 6.4% of GDP. Usually it's about 3.8 over the last 50 years or so. So historically very high, and potentially moving a bit higher as it's unlikely that these tax cuts are going to be fully paid for by spending cuts.
Yeah, it's, this notion of tariffs are going to cover the whole thing, and, tariffs are going to help us get out of the deficit is just not possible. I mean, unless we just, it doesn't work. But I guess in the eyes of the consumer, right, if that's how we're looking at it, right, the extension of the Tax Cuts and Jobs Act is a positive, right? We're going to continue to keep, tax rates the same, and then like you said, I like I like the term sweeteners added on top. I think that's a positive development when you look at it from the perspective of the consumer. When investors think about political risk in this environment, are we overestimating or underestimating what that political risk could be, right? I mean, if we see, and I guess my example will be, I guess it was underestimated how quickly these tariffs could be implemented, right? And then we weren't really positioned well for it. The market reacted negatively. I think going forward, are we positioned for more upside surprise or downside surprise when it comes to the political risks that could be out there?
Markets seem to be absorbing some of these political risks a bit more realistically. And I'd point to the bond market in that regard, because what we have seen is a rise so far in yields.
Hmm.
In fact, we're not so far from where we started the year, but we have been on a journey where yields rose a bit, they came down, but they didn't come down as much as you'd think in the environment of maybe we're headed towards a severe recession. But if you think about the first week of April, where there was a lot of concern about how tariffs would impact the economy, you saw the 10-year Treasury yield go to around 4%. If it were truly a safe haven environment, you would expect the 10-year Treasury to go to something closer to 3.5 or below, given the extreme market moves that we were seeing in that period of time. You basically had a 10% sell off on top of the 10% sell off that had already happened. So that was a bit interesting to see that there was somewhat of a floor on Treasury yields.
Hmm.
And now yields have moved their way higher and higher. And if we think about some of those competing impacts on the 10-year, if you think about the shorter end of the curve, that's really about Fed policy. So the movement we've seen there is markets pricing in one Fed cut back in January, to 5 in April, to 2 weeks ago about 4 cuts, and now about 2 cuts. So that's what's going on the shorter end of the curve. Think again about the 10-year. Typically, the 10-year is governed by growth and inflation expectations. So if we were expecting slower growth, that would pull yields down. We're expecting higher inflation, perhaps from some tariff impacts or just some sticky inflation from what we already have, that's going to push yields up. Once you started to see that there was more trade negotiation going on over the last couple of weeks, China, the UK, you started to see yields drift higher because that one factor that was pushing on yields in the lower direction, potentially we have recession, we have much slower economic growth, started to be alleviated a little bit. On the other hand, on the upside, instead of seeing treasuries act as a safe haven in this environment, instead what you're seeing is that people actually want more compensation for holding US debt, because there are some fears about some of that political uncertainty. There are some fears about the fact that the deficit is probably going to continue to expand and move its way higher. So therefore, if you are a more price sensitive buyer, which arguably we have a lot more price sensitive buyers in the market because the Fed's not the big buyer of
Hmm.
treasuries anymore, then you're going to want to reflect that in terms of how much you're willing to pay and how much you would like in terms of compensation from a yield perspective. So the short answer to your question is I think we're starting to see a more realistic pricing in of political risk. You're also seeing that in the US dollar. Typically during periods of stress and uncertainty, you see the dollar move higher again. People move in there as a safe haven flow. And that's not what's been happening so far this year against broad expectations.
It's I like how you molded that into what we're seeing from, or how the market's positioned. So the other thing that affects how the market trades is earnings, obviously, right? Earnings and how companies report. So let's dive into sort of what we've seen from Q1, right? We've had all the earnings reports from Q1 come through, and we've seen, I guess, some mixed results, right? We've seen some positives, some negatives, some sort of right in the middle. I guess broadly speaking, right, when we look at the aggregate, what did we hear from companies in Q1? Is there anything specific or anything notable that we heard?
It's all about tariffs and time frame around uncertainty. Pervasive uncertainty was probably a big theme there. What we came into expecting in earnings season was about a 6% year over year growth rate, roughly between 6 and 7% on S&P 500 earnings. Instead, we saw something closer to 13%. So we basically doubled the expectations, and those profits were very strong. However, underneath the surface, as it relates to that uncertainty and tariffs, you did see some degree of front-loading activity, customers buying things ahead of tariffs being implemented, companies kind of building up on some of their inventories, some of their production to make sure they were well positioned. So some of that front-loading activity also helps to boost overall profits. Now, I'm not saying that was all of the story. I think that profits were also an incredible reflection of an economy at that time, the first quarter, that was pretty strong. Let's see how things continue to play out from here. Because what we also heard is some of the more discretionary areas of the market, airlines, for example, said, we're going to cut some of our capacity because of this uncertainty, and we're just not seeing as strong of consumer demand. Essentially, what tariffs do to the economy is stagflation. Slower economic growth, stagnant, and inflation, higher inflation. So if consumers are saying, well, my concert tickets, my movies, my airline tickets are expensive and I need to buy my groceries, those are getting more expensive. I'm going to cut back on all of this other stuff. So I think that some companies are preparing themselves for consumers to cut back. We were also hearing about what exposure different companies have to overseas revenue, to how much margin cushion they have if they do have to absorb some of those higher costs. So, for example, areas like technology, materials, a lot of foreign source revenue, a lot of foreign supply chains, so exposed in that regard. On the flip side, take a sector like technology, and it has very generous margins relative to other sectors and relative to its own history. So, if prices are going up, it's probably one of the areas that's well poised to absorb some of that cost increase. On the other end of the spectrum, some of those consumer sectors less well poised from a margins perspective to take some of that on. And then there are other sectors that say, this is not really a first order effect for us. So, for example, financials. Yes, financials are certainly impacted by the overall macro environment. They're very much a bellwether for the macro environment, but service oriented. So maybe a bit more insulated from tariffs. Or utilities, very domestically oriented. Again, there's some degree of insulation. So I think when we consider the impacts of tariffs on profits, we have to consider how much exposure there is, whether it's supply chains or revenue, margin positioning going into this, goods versus services. And it's really got to be assessed on a sector by sector and company by company basis.
Do you think the pull forward or pulling forward of buying certain goods that we've seen is that a trend that you think is going to continue for the next couple quarters, or do you think, with the pauses that we're seeing in the tariff stuff, consumers might slow that down a little bit?
I would imagine a lot of the pull forward that was going to take place probably has
Okay.
taken place now that the higher tariffs are starting to filter their way into the economy, but it will be a lag until we really start to see some of these impacts taking place and showing up in the data. So I would say
Gotcha.
throughout the summer and into the fall, you'll start to see more of a reflection. If indeed tariffs do cause higher prices, we'll start to see that showing up in inflation numbers and PPI and profits. If there is any slowdown in the economy, that will also likely start to be reflected over time. But it will take some time. And I do think that probably a lot of the front loading is behind us. And the flip side of front loading is then you see some potentially slower demand on the other side. So the key question here is to what extent? To what extent do
Right.
prices go higher? To what extent does growth slow?
I think, and let me know if you disagree with this, but I think in aggregate Q1 was probably better than what people expected. Um, the market has, it seems like it's bottomed, and we've only continued to go higher since earnings have come out. Do you think that's a function of underlying strength within the economy that was maybe a little underestimated? Do you think it's a function of earnings estimates just getting beaten down and those being beaten to the upside by companies? What are the thoughts there?
We've had 4 consecutive years of above trend economic growth. So every year in our outlook for the last couple of years, we've said this is probably the year where the economy slows back to trend or maybe slightly below it. And every single year we've been wrong because the economy has showed just so much resilience. And even though things like excess savings have dried up from a consumer perspective, from the pandemic transfers, people still broadly have jobs. The unemployment rate is around 4%. Generationally, this is pretty low, and it's been that way for 3 years. So, psychologically, if you're a consumer, you probably feel pretty good about your job prospects, pretty good about getting another job if you needed to. Your wages have also been going up, even on real terms. Even in the last 2 years, when you subtract out inflation, real wage growth has been positive. So, there are certain supports to the consumer. And on the economic side, if I looked at the first quarter GDP report, which was slightly lower, you had one of the biggest contributions essentially ever from trade on the downside. Again, representing some of that front loading, lots of imports. Trade is not a big portion of our overall economy. On the flip side, adding to economic growth, you had a lot of contribution from inventories, and again, that build in inventories. So even if you chop off those tails, you had a pretty healthy growth rate from just consumers and businesses. The challenge is how do you know who was front loading and who wasn't? You had a big increase in things like equipment from a business's standpoint. So maybe that was some front loading there. But I think in reality, if you strip away all the trade impacts, we probably still would have had a positive GDP quarter. So I think that does represent some underlying economic strength. And if we think about just the money required to do all this extra importing and build all these inventories, clearly the wherewithal even just to do that was there. And then from a market perspective, I would say that the first week of April was the high watermark overall for volatility because of the magnitude and the severity of the volatility that we did see. That doesn't mean we're not going to see pockets of volatility throughout the rest of the year. So something I think that we need to be mindful of, because valuations are back at 21x plus, and probably profit expectations for the rest of the year, which came into the year at 9+%, or excuse me, they came into the year at 11+%. They're now around 9+%, probably still a little bit unrealistic on the upside. So expect some pockets of volatility throughout the year, particularly when you think about things being priced to perfection relatively.
Yeah, and we'll certainly dive into the valuation piece of it a little bit further. One question I had for you: what do you think about the concept of sort of the top 20% of net worth, or that I'm going to mess up the terminology. I guess the high end consumer, right? Sort of the top 20%, the whole that basically control the majority of the wealth in the country, are really high income earners. What do you think of the concept that they're holding up the economy, right? Because all the stuff that we're really seeing isn't changing how they spend predominantly. How does that concept resonate with you guys? You guys do a bunch of data, or have a bunch of data on this. You have some really good stuff in the guide to the markets on this. But I guess, what are the thoughts there?
What we saw coming out of the pandemic is you saw wage increases primarily for a lot of the lower income cohorts. So it very much helped from a wage perspective, so the lower income earners. You had a lot of those fiscal transfers from the pandemic, whether it was the stimulus checks or various moratoriums on payments, really accruing to, again, some of the lower and middle income households. So in those first few years, a lot of that spending was coming from a broad cross section of the population, and people were spending on goods, services, basically everything. Then as we get further on out and some of that excess savings is spent up, inflation is really starting to bite. People start to spend in different patterns. Maybe you see some of the lower and middle income consumers become a bit more value conscious, pulling back. You start to see an uptick in things like auto and credit card delinquencies. Student loans has picked up pretty significantly in the last couple of weeks that we've started to see the data come through. And really a lot of the spending is happening at the upper income levels. Now, that is certainly notable. But what we have to remember is when we think about profits, for example, those are still aggregate. Now, at individual company levels, it's going to certainly impact different companies in a different way. So we have to be mindful of who their clientele are and who their market segments are when we think about investing. But also from an economic perspective, our GDP and consumption is measured in aggregate. So it's not about who's spending on what, it's about how much spending was there in total. And the aggregate consumer balance sheet is also in pretty good shape. If you take a look at assets and liabilities, for every $10 in assets, consumers have about $1 in liabilities, and about 2/3 of that is mortgages. And most people were able to lock in a mortgage at 4% or below during a very extended period of low rates. So the debt service aspect as a whole is not that big. If you think about auto loans, credit cards, again, those are, together barely 15% of overall liabilities. And remember, $1 in liabilities for every $10 in assets. And it's also, similar to how we would think about the federal debt. It's not about the actual size of the debt, but it's about your ability to service that debt. And what we can also see is that when we look at consumers' ability to service debt, it's become less good than it was a couple of years ago coming right out of the pandemic. But we also had a sharp dip where people's wages went up, people had transfer payments, people paid down their debt. So it was looking unusually good. And now it's kind of right back to where it was prior to the pandemic. And it kind of flatlined at that level for a number of years. So overall, I would say the aggregate consumer is in good shape. Yes, there are some cracks underneath the surface. Yes, a lot of the spending is coming from upper income individuals, but the economy is measured in aggregate.
Yeah.
And broadly, people have jobs. That's always the helpful factor.
Right. More people are working today than ever before, which is fantastic. When we talk about, recession risks and, the economy was at such an elevated level and it's normalized a little bit. In 2022, when the Fed started hiking interest rates and they did so at such a rapid pace, the consensus was a recession, right? I don't think there was a single strategist not calling for a recession. Maybe a handful weren't. But I think we underestimate the fact that, and it's sort of a hindsight thing when we look at it, that everybody has, as you mentioned, mortgage rates that are financed at super low interest rates. That's super beneficial. I don't think we look at that enough. And we really didn't see it in the present because we've never really been in an environment like that before, where so many people have had these rates locked in at such low rates. And because usually it's a huge driver of a recession, right? We see, mortgage delinquencies rise. We can't, people can't finance a mortgage. So that definitely, I think, is underestimated in terms of why the economy has been so strong over the past couple of years.
And it's not even just the idea that mortgages have been fixed out for a long time. Even debt of companies, corporate debt has
Yep.
been fixed out for a long time as well, particularly at the larger cap end of the spectrum, where you see at least half of S&P 500 debt fixed out for 2030 or beyond. And, by some estimates, much more than that. So when you started to see the rise in interest rates, we've just fundamentally become a less interest rate sensitive economy when you think about mortgages, when you think about corporate debt. And so that has certainly been a tailwind. Now, it does mean as rates come down, perhaps it's less of a stimulative impact as well. But at least for the pretty significant rate rises we saw, it then didn't prevent us from having two back-to-back 20+% years on the S&P 500
Right.
in 23 and 24. So clearly, valuations are a lot more resilient to the overall interest rate environment as well. And overall, I would also pick up on your point about recession probabilities. We're definitely going into recession 2022. We're definitely going to recession 2023. We still might go into recession this year because we have maybe some less wind at our back on the consumer end than we did at the time. And sometimes uncertainty causes businesses and consumers to wait and see and therefore not spend and invest. But it is obviously certainly not a foregone conclusion because, again, we've seen many instances of unusual economic resilience in the US. If we do go into recession, because of some of the things we've laid out, it could be a lot milder. You, again, you don't have as much cyclical access. I think that's also one of the things that you were getting at is in terms of what might usually cause a recession. Usually there's some sort of cyclical overbuild. We built too much housing. We have too many inventories. We have too many autos. We've done too much CapEx spending. A lot of those factors are relatively in check. When you look at the labor market, while it's very tight, at the same time, you still have a lot of companies saying, I don't have enough workers. I don't have the right quality of workers. So if you get to a recession and companies have any wherewithal to just hold on to the workers that they do have, they may not want to let them go, in which case maybe you don't see that big of a rise overall in unemployment. So all of these different factors could lead to, if we do see a recession, potentially a much milder one overall.
Yeah, I saw two questions with that, but one I think is really similar to what you touched on. We sort of have this fight for talent right now between companies, right? So what you mentioned is companies don't really want to let certain people go because if they do in a couple months when the recession's over, they might not be able to get a person of that quality back. So they're willing to bite the bullet, continue to make payroll for certain individuals, just because they need to retain top talent. And I think that's something that I don't think is going away. And it's a benefit, right? And I guess that flows into my other question, which is, if we do see a recession come, is there a part of the economy that you think will get hit first? Or do you think that we'll see it in first? We've seen this concept of a rolling recession has been floated over the past couple of years. And I think in 2022, it's possible that we could have seen one. But if we see like a true recession, do you know if there's a part of the economy that we could see it in first?
I have heard the old term hope. You see housing, then output or production, profits, then employment. And usually employment is one of the last things to get hit. So I don't know that it will necessarily show up in the job market first. Now, again, some of these areas are a little bit distorted given where we've been. I mean, certainly the housing market is distorted because we've had an underbuilding of housing and don't have necessarily as much inventory. And because of where mortgage rates have been, the housing market has been somewhat of a skewed barometer to begin with. when you think about things like production and output, manufacturing can be a pretty good litmus test, but remember that's going to also be tied up in tariffs, and some of that could potentially cause a bit of a pronounced slowdown there if people don't want to produce as much because we're just trying to work our way through the inventory that we have pre-tariffs. So you could potentially see it in some of that manufacturing activity, although again, manufacturing has been weak for the last couple of years to begin with. Perhaps we look at it in terms of some of the services spending areas, because again, if people start to get nervous about the economy, they may want to pull back on some of the spending that they are doing, and that could happen in the most discretionary areas. And then what we see from a business standpoint is while consumers sometimes engage in retail therapy and want to spend through the pain, essentially businesses don't really do that. They do try to batten down the hatches a bit, and they might pull back on capital spending. They might pull back on hiring. So then we would pay close attention to what are businesses doing, and how are they telegraphing their sentiment around what's going on.
Speaking of batten down the hash, yeah, yeah. And, speaking of that, you wrote a fantastic piece a couple weeks ago, batten down the hatches, where you sort of dive into a whole bunch of this stuff. Um, do you think, this is a silly question, I guess, but do you think it's possible that we avoid a recession altogether this year? I mean, I guess it's base case now, but and the reason I ask is because, we sit across from clients all day, right? Five days a week, and the amount of times that people walk in here and think we're in recession, or you just speak with somebody, maybe speak to my barber or somebody else, right? It's, a lot of people think we're in a recession right now. So yeah, I guess, from the consumer standpoint, right? It's like, how do we get the messaging across that the economy's in a good spot and, things aren't as bad as they may seem?
It's definitely challenging. And I think things like social media and broadly people's access to constant information and different viewpoints does create multiple sub narratives. And if you look at consumer sentiment over time, what's shocking is to see it near an all-time low. And the all-time low, back since it's been measured since the 1970s, was June 2022. So again, all in this post hyper information environment. Both of these instances are lower than 2008, than the tech wreck, than all of these really calamitous periods of time. So it's interesting to see that people's sentiment is so down in the dumps compared to some of the prevailing metrics on the economy. Now, I will say that, of course, all these different metrics on the economy are aggregate measures, so they may not reflect the individual circumstances of different people across the country and in different parts of the population. But this has become a big question. Every time we start talking about recession, you get questions of people saying, are we already in one? And we're going to look back and say, hey, we were in one the whole time. Or are we going to avoid it entirely? Is it going to be like 2023 when it seemed 100% of a chance that we're going into recession? And in fact, we had a lot of resilience. So it's not a dumb question at all. We kind of get to this point and it's 50-50. We could potentially head into a recession and we could potentially avoid one altogether. And when we think about all of the different scenarios that we have afoot and all of the different competing impacts, whether it's policy or non-policy, this is how it's become so hard to assess.
How about the concept of, like, because we've been avoiding it for 2 years or 3 years now. What about the concept of let's just do it, get it over with, reset, and move forward?
Well, I think that, in our age of wanting to check things off the to-do list, that is tempting. But look, recessions are painful, and we don't want people to lose their jobs unnecessarily. We don't want to have any setbacks that are, again, not entirely required to American consumers and families and individuals and households. So I would say the let's get it over with. If you feel that way, then you also have to ask yourself, okay, but I'm the one getting fired. Right. If you're okay with that, then let's get it over with. But I imagine most people probably are not. And, a lot of people don't have enough savings to kind of get them through some of these more challenging periods. So we want to be mindful of that. I'd also say, we don't need to have a recession necessarily. Expansions don't die of old age, we like to say. We had an incredibly long economic expansion from the financial crisis through the pandemic. And outside of the pandemic, we may not have had a recession at all because that was a completely exogenous shock. So we have seen over time is that we have longer expansions, shorter recessions. So I don't think it's something that we need to prematurely cross off our list for an economy that is fundamentally, I mean, look at all the data we've gotten throughout the first quarter. Although you can caveat it and say, well, that's a reflection of the past. This is a new environment, post policy, post tariffs. That's not reflecting that. At least it is reflecting a really strong starting point. And the last couple of years have been a really strong starting point. So it is certainly not a foregone conclusion. And I don't think we need to get it over with necessarily. We don't need to necessarily have one if things are not, wildly off course.
I love how you answered that. I think it's extremely well put. Um, I think a lot of the concept around, we've seen shallow recessions and longer expansions has to do with what you mentioned earlier, which is we've become more of a services based economy, right? I mean, you think about like TV streaming, right? There's you pay $15 a month to get access to everything, and it's even if you lose your job, why are you going to cut your TV streaming service? Right? There's other things that you're going to cut in before that, whereas historically that might not have been the case. Um, so I think the evolution of going to a services based economy has definitely helped us keep recessions more mild, shorter duration, all that stuff.
Technology has definitely helped. Again, I mentioned that a lot of cyclical swings have caused recessions in the past. The overbuilding of housing was certainly one that we had coming into 2008, but we used to have inventory swings that could cause recessions. Now, with just in time inventory, people are much more careful about how they manage that so that we're not seeing these big swings typically. When you think about auto production, same thing, capex, people are just able to be a bit more mindful given some of the technological enhancements that help us measure and plan and plot out and react in really short order to wanting to pull back where is necessary.
Perfect. Let's sort of dive under the hood a little bit and talk about equities. You've mentioned valuation a couple times. Um, I think one thing that's notable though with what we've seen so far this year, up until a couple weeks ago, I think value has sort of been in the lead this year, right? We've seen value sort of hold up. Tech and growth has sort of taken the biggest hit up until a couple weeks ago. Do you think that's something that we're going to continue to see, right? We've seen outperformance from growth for such a long period of time. Do you think we're going to see sort of that rotation back into value, and value is sort of going to lead for the short to intermediate time frame? What are the thoughts there?
We could have a nice run for value. And certainly when you've seen volatility pick up the most this year, that's when value has happened to protect. And I think a big element of this is around valuations, because valuations in some of the growthier areas of the market, and particularly in some of those big tech stocks, have been extended, and they've been extended for quite some time. And when markets are priced for perfection, they are primed for correction. So something that we need to be mindful of in any environment, because as soon as you start to see some of these risks and some of these challenges materialize, that's when all of a sudden all bets are off, and those valuations come down. I don't think that the story has fundamentally changed for things like the Mag 7 and some of the AI innovation and the CapEx. Certainly, there's some more vulnerabilities around tariffs, but it's more than anything, I think, that they just got over their skis from a valuations perspective. And people remembered, hey, there's a lot of other really high quality areas of the market. People got a little bit more nervous about the markets and said, I want to get a bit more defensive. Let me think about areas like utilities or real estate, which has already gone through a massive repricing in the last couple of years, or healthcare, just wanting to get a bit more defensive. Now you also have areas like, again, I mentioned earlier, financials. They're more cyclical, but they might be less exposed to some of these different risks that we're seeing. So certainly, I think it's a reminder that there is a really important role for being diversified across the board in a portfolio. You don't know what's going to outperform at what time and why. So having a little bit of everything does help. And gearing towards quality, whether you identify as value or growth, as long as that's quality and there's a good solid business with a good balance sheet and good an eye towards that those future earnings, then having different types of businesses can really help when you least expect it.
Yeah, capex is a really interesting one because all the hyperscalers reported this quarter, and they all doubled down on all the capex spend. I mean, AI is a real thing that they're going full into, and it does not seem to be slowing down whatsoever.
It does seem like the general attitude is there's a bigger risk to underinvestment than overinvestment right now. And you definitely see this in many areas of the technology space, particularly things like the chip space, where if you don't take advantage of the lead you have when you have it, you could fall behind. So I think that they're all in that camp right now, wanting to make sure that, hey, a lot of them have a lot of cash on their balance sheets. A lot of them have very high margins. They've done well. And a lot of the AI investments are generating revenue. They are certainly translating to profits overall, whether it's monetization itself or AI usage, that there's a clearer trajectory that these investments could have some legs. Maybe we will get to a point where they say we've invested a lot, now we need to harvest those investments and things start to slow, but we're clearly not at that point yet from an innovation timeline perspective. So I think it is a good sign that some of these capex intentions are not so sensitive to some of the different swings in what's going on in the markets, and that they are longer term secular investments that these companies feel that they need to make and have the wherewithal to make to maintain their competitive edge and continue to put out new and different products.
Yeah, I mean, I was just at a conference recently, and we see, wealth management firms who, do, a few $1 million a year investing heavily into AI and building out AI infrastructure. So I mean, it's not just the massive, biggest companies in the world. It's family-owned businesses. I mean, it's all parts of the economy.
Yeah, this is sort of phase two, where phase one is you have a small number of companies that are creating the technology and disseminating it. Then as you broaden out from there, it's all of the different inputs into that AI and into that technology, whether it's infrastructure or power. Then you get to the next level of, okay, well, we're deploying these tools. Who's going to use them and how are they going to use them to their benefit? Think about it very much like the internet. A couple of players in the very beginning, internet stocks, and now everything's an internet stock because everything is internet based in one way or the other. So I do think about this as a broadening out over time and opportunities that AI brings about. And you see what these companies do. It's not just the tools that they're selling to other people. It's also the investments they're making in their own business, creating code with AI, using it to generate users and better sharpen their own products that are maybe not AI related specifically, but that can enhance their value proposition. So there's a lot of different applications here, and it's going to get broader and broader.
Yeah, I'm so interested to see and excited to see where it goes in the next couple of years. I'll pose the same question about international that I did, about value at the intro. International has done well so far this year, right? It's underperformed the U.S. for an extended period of time. Is this something that could have some legs to it? And then you always hear the argument of it's the cheapest compared to the U.S. that it's been in a long time, but in my experience, valuation is not enough to justify outperformance. What are Tell us a little bit about what you think in terms of international going forward.
You need the valuation, but then you also need a catalyst because
Right.
things have been cheap for years now, and that really hasn't caused a turnaround. But now you have some more catalysts on the margin. Think about areas like Europe. They're cutting their rates down to 2%, whereas we're maybe going to 4%. That is a big tailwind there, especially because have become a less interest rate sensitive economy over time. They have not. They still do a lot of bank lending, much shorter term in terms of mortgages. So that could be a big tailwind there. They have also spent a decade plus in fiscal austerity and now are very much willing to do some spending on the fiscal side, particularly around defense. We've seen some upward earnings revisions there. We've also seen upward earnings revisions in areas like Japan, massively actually, and seen the valuations pull back a bit there. Currency has also been supportive internationally for the first time in a long time. So it's not just your asset return, it's also as a US investor, you get that currency return hedging back to dollars. So a few different drivers there that could have some legs. Do I think this is going to be, again, a shift from growth dominance to value dominance, US dominance to international dominance? I wouldn't say we're going to see a paradigm shift here, but what I will say is, again, things can become a little bit more competitive, especially at the individual company level. If you look at the best 50 stocks globally right now, 46 of them are from outside the US. Only 4 of them are US companies. And if you look over time, it's usually been about 60% of the best companies are outside of the US. So it is important to be again, playing in different stadiums here because you certainly get some benefits of not just being in one place. And no one would have thought this year growth wasn't going to work or US wasn't going to work. And yet we've seen that a lot of those really unloved areas of the market that clients have been like, why do I own this? I don't want this anymore, have really come to save the day this year. And I think that's critical.
Yeah, it's the diversification um, discussion has been enjoyable to have this year. That's for sure. Let's dive into the sell America, American exceptionalism, or yeah, exceptionalism is dead. It's something that you mentioned at the early on, and it sort of blends into the discussion on international doing well as well. Um, this belief, in my opinion, is just overplayed right now. I think we're talking about AI, we're talking about all this good stuff going on in the U.S. And sure, it's easy to focus on a lot of the negative stuff, the deficit, stuff like that. But for the way that I think about it is, as long as we continue to have the entrepreneurial spirit that we've had for such a long period of time, and just the want to innovate and do more and create better things, I just don't see that trend dying anytime soon.
I would agree with that. Let's also think about the starting point in the context that we came from. We had 4 years of above trend growth. We've had 3 years of an unemployment rate around 4%. We've had 2 years of positive real wage growth. We had two back-to-back years of 20 plus percent market returns in the US. We've had a high dollar for many years now relative to its long-term average. We have seen 10% profit growth last year. So if you put all these things together, we were ripe for some sort of rebalancing when we think about some of these dynamics, just a normalization in some of these dynamics that cannot simply persist forever. So I think that's what we're seeing here, a bit of a right sizing of those dynamics. It's not just one country in this world and in this market, but there are many other countries, and many other countries produce a lot of value as well. So it's, again, less sell America, the downfall of US exceptionalism, and more a normalization of dynamics that have been at pretty extreme levels for quite some time.
What do you think this concept or this belief has had on the dollar, or the impact that it's had on the dollar? Right, we've seen the dollar fluctuate a lot so far this year, but do you think it's a lot to do with this belief, or is there other stuff that, and we might not actually know which is which, because you never know who's selling for what reason, but or buying. But what do you think about that?
It does tie into all of this. And in fact, I think is raising some and stoking some fears about all of this, because what you would expect in an environment where the US is putting tariffs on other countries is perhaps there would be this political uncertainty, and therefore safe haven flows might go back to the US. And instead, what we've seen is a lower dollar, much markedly lower than where we started the year, and a pretty sharp sell-off in the overall dollar. So I think it is feeding into this narrative because it is not functioning as the safe haven. Neither is the treasury market functioning as the safe haven. But again, that starting point really matters in terms of the dollar being above fair value for years, and some of the other dynamics supporting a lower dollar. Think about our twin deficits, trade and fiscal. They would suggest that the dollar should be moving lower. So while it probably happened in a sharper fashion in a shorter period of time than we would have expected, nonetheless, um, it perhaps was overdue to happen at some point.
Right, right. I think that's a great point. Let's round it out by talking about the Fed real quick. And it's a big topic of discussion because you have some people say, well, the Fed put is real, and that's people can debate that all they want, but we're most likely going to see cuts this year, and it's always changing how much we may or may not get. But if we see cuts in aggregate, that's a positive development for equities and the market in general, is it not?
Depends. It always depends why the Fed is cutting. I mean, if the Fed cuts 4% because we're going into a massive end all be all recession, then that's a bad cut because clearly they're doing it to preserve overall economic growth. If the Fed cuts dramatically less than the market expects because the Fed doesn't really need to cut because the economy is on track, then that's also a good thing. So I think it always matters why the Fed is cutting, and how much they're cutting in response to that reaction, or, how much they're cutting in response to that reason. But I would say on balance, we do expect the Fed to cut very modestly this year. They're very much employing a wait and see approach, which I think has been a good approach when we think about some of the policy swings that we've seen so far this year. But they've had to weigh slowing growth, which would potentially cause them to want to cut, relative to maybe inflation will move a little bit higher, in which case they would probably want to keep rates right where they are. And that's why you've seen market expectations reflect anything from 1 to 5 to now around 2 cuts, because ultimately we have to see how the data plays out. And if optically we get to the point in the summer where growth is slowing, but inflation is actually moving a little bit higher because of tariffs, even if it's more of a one-time pass-through from an inflation perspective, optically it would still be difficult for the Fed to want to cut rates until they've seen sort of the other side, and they know that inflation is just a pass-through and it's coming down after the initial uptick from tariffs. So I do think that they're probably going to try to cut as little as possible and perhaps wait until the fall to see what they actually need to do.
Interesting. Do you think the president's going to have any impact on how many cuts we get? I know he wants them.
The Fed is an independent body from the president. Yeah. Jay Powell has reiterated that time and time again. He's doing what he thinks is right based on the Fed's dual mandate of stable prices and low unemployment, and so, stable prices and low unemployment. So I think that the Fed will continue to act as independently as it possibly can, and has really reiterated that view.
There you go. That's a great way to finish it up. That was fantastic. Thank you so much for taking the time to do this. Your insights are fantastic.
Thank you so much for having me.
Of course. You've gone in depth on so many great things, and it's just great to hear what you have to say. So again, thanks a lot. We greatly appreciate it. And thank you so much, everybody, for tuning in. This is the Sharpe Minds podcast, and we greatly appreciate the support, and we'll see you in the next one. Thank you so much.
Sharpe Minds is produced and hosted by Michael Lafata and directed and edited by Alex Weimer. Our music is made by Tony Sapiato and licensed through Soundstripe. Michael Lafata, Financial Advisor, Archstone Financial, 508-453-9800, 324 Grove Street, Worcester, Massachusetts, 01605. Securities and advisory services are offered through Cetera Advisor Networks, LLC, member FINRA, SIPC, a broker, dealer, and registered investment advisor. Cetera is under separate ownership from any other named entity. Archstone Financial is not a subsidiary nor controlled by Cetera Wealth Partners. The views stated in this podcast are not necessarily the opinion of Cetera Advisor Networks, LLC, and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Due to volatility within the markets mentioned, opinions are subject to change without notice. Information is based on sources believed to be reliable. However, their accuracy or completeness cannot be guaranteed. Past performance does not guarantee future results. The guest speaker interviewed in this podcast is not affiliated with or registered with Cetera Advisor Networks, LLC. Any information provided by them is in no way related to Cetera Advisor Networks, LLC, or its registered representatives.